Hi, I'm Ying Yan Cheng, Portfolio Management Director at Coolabah Capital. And I suppose I want to frame today's discussion or presentation to the Switzer Income Conference around generating high returns from active credit alpha. I'll start off today with a bit of a conversation and discussion around RBA and also our views around what the implications of lower rates means also for investors, particularly with respect to fixed income, which is where we specialise. So to begin with, we've had the view since August that the RBA would do further easing. We had the view that the RBA would cut the cash rate from 25 basis points to 10 basis points in November, which we've been vindicated on. Similarly, we've been expecting that they would cut the cost of the term funding facility for banks from 25 basis points to 10 basis points as well. So the term funding facility is whereby the banks can borrow off the RBA out to 3 years at what was previously 25 basis points to 10 basis points now. In addition to that, we had expected them to lower the 3-year government bond yield target to 10 basis points. In addition, we also expected that the RBA would purchase longer dated government bonds of between 5 to 10 years in tenor. And we expected that the RBA and APRA would also force the banks to switch their $223 billion committed liquidity facility, which is an emergency borrowing facility for banks, into government bonds and state government bonds over time. And we've been vindicated on all of those. So in terms of what the RBA actually did earlier in November, firstly, they did cut the cash rate to 10 basis points. In addition to that, they also cut the rate that banks earn on their deposits with the RBA, known as their ES balances. So they actually cut that to zero. In addition, they cut the 3-year term funding facility rate from 25 basis points to 10 basis points, as I mentioned, and they did the same for the 3-year Commonwealth government bond yield target. In addition to that, what they've said is that they would start buying $100 billion of 5-year to 10-year Commonwealth government bonds and state government bonds over 6 months, with potentially a view that, our view at Coolabah is that we expect them to extend this QE program for at least another 6 months on top of that as well. So given that rates are very much at their lower bound, what are the implications? So firstly, we are already starting to see downward pressure on bank deposit rates. In addition to that, what the RBA is encouraging is then investors and savers to chase high yielding assets, whether that be in riskier bonds or for example hybrids or equities and property. And for institutions like banks as well, they're encouraging them to chase higher yielding liquid assets. So Commonwealth government bonds further out in the curve or longer dated in tenor, and also state government bonds that are also longer dated as well. Why is the RBA doing bond purchases in addition to cutting the cash rate? Well, firstly, this has the effect of reducing long-term government bond yields, which is good because it lowers the cost of borrowing for the government. In addition to that, it discourages foreign demand for Aussie government bonds, which means that there's less upward pressure on our Aussie dollar, which means that, given the fact that we're deterring that to some extent, it makes our exports hopefully more competitive as well. And the RBA's own internal research finds that quantitative easing boosts jobs growth and GDP, which is what we want at this given point in time. So what are our key forecasts for investors given, what's happening with the central bank in Australia, such low rates, etc.? Well, the search for yield is going to be as strong as ever, particularly since we've already seen that the banks have lowered their TD rates or their term deposit rates fairly close to zero. And we think the implications of that is that it will force a lot of naive investors to chase risk, whether that be in high yielding equities or private credit or in high yield bonds or in non-bank residential mortgage-backed securities or asset-backed securities, and especially their subordinated tranches as well. So that's something to bear in mind. On the Aussie economy, we actually think that our economy outperforms, given that we've seen record fiscal stimulus and also just an RBA that is quite literally willing to throw the kitchen sink at the moment in terms of stimulating the economy and getting to a rate of full employment again. We're quite far away from that. In addition, given we've got high commodity prices and we're benefiting from that, and very strong jobs growth as well. In addition, I suppose once we reopen our borders, then we should also see net overseas migration, which we expect to increase robustly over the next 3 years. And as I mentioned earlier, there's quite a lot of Australians that have returned home, so 480,000 in fact over the last 12 months. And we think that there are plenty that are waiting in the wings to return back to Australia as well. As I mentioned, we think that housing is a very strong asset class, and it's likely to be the best performing asset class as well, particularly with the investor market likely to come back online next year, given that we have positive gearing at the moment as well. For fixed income, I suppose the key here is, as we mentioned, the search for yield dynamic affects all asset classes, I mean. In terms of the search for yield here, typically in fixed income, you can drive returns through several sort of ways. But most often in fixed income, managers try to drive returns through taking on more risk. And as we mentioned, chasing more risk exposes you to higher probabilities of losses as a result. And I think in this environment, it requires a much more active approach that focuses on generating capital gains rather than income or yield, because in fixed income, the yield or the coupon that you're receiving on a bond is actually the best proxy of risk. Now, we also think that it also requires a highly active approach, which requires a very large team and very active trading as well. Much more like an active equities manager than your traditional buy and hold to maturity bond fund as well. That's overseen by quite small analyst teams. So I suppose this ties in neatly, into Coolabah Capital. So a bit about Coolabah. We were set up in 2011 and we launched our first fund in February 2012. Now we are running more than 22 portfolios, including 4 public offer funds. Funds under management is actually more than 4.6 billion today, with AUM or assets under management of more than 7 billion as well. And you can see in front of you on the right-hand side our organizational chart. So we have an incredibly large team, a much larger team than your typical fixed income fund manager who might have 2 or 3 portfolio managers and 1 or 2 analysts. So our team is made up of 5 portfolio managers and 13 analysts, multiple PhDs and university medalists as well. And we have 4 offices, so 2 in Sydney, so 1 in the CBD and 1 in Bondi Junction, 1 in Melbourne, and also 1 in London. And we are the most active trader of Aussie fixed income. So typically we're trading between, up to, if not more sometimes, actually, 70 times a day, typically around 100 million. But there's been a day this week where we've traded, 150 million. 2 weeks ago, we traded around 500 million in a day. So we're super active, and that's how we drive returns. So our process, and I suppose, is multifaceted. It's relentless. There's relentless iteration, I should say, and constant surveillance. So broadly about the team, I should have mentioned is that, there's the portfolio management team, but we also have a dedicated credit research team. So these are more of your traditional credit analysts, and they're doing what we call the traditional, due diligence work. They're building up their own cash flow models, and they're assessing, the viability of these companies that we're potentially looking at. I should say, more than just companies, it could be entities, so state governments as well. In addition to that, we also have a dedicated data science team. So there are 5 people within our dedicated data science team, and they have built 30 to 40 different quantitative valuation models that we have coded up in-house. They're all proprietary. We don't buy anything off the shelf. And we're using that as part of our understanding of, identifying cheap bonds or mispriced bonds, which I will go into in further sort of detail. So our process collectively is a quantamental process. You can see, a strong component are our valuation models, top-down multi-factor models, bottom-up models, which ignore market pricing, also a series of quantitative credit rating models as well. So very similar to the ones that S&Ps and Moody's would use. In addition to that, we're fusing that with market technicals analysis. So understanding the demand and supply dynamics of our market, and also obviously strong macroeconomic research, which is, led by our dedicated chief macro strategist and also our CIO as well. So taking a step back and, revisiting the whole premise of, generating returns within fixed income. I alluded to this when I mentioned that in fixed income, typically, if you want more return, managers or investors can take on more risk. And, they can do this in the form of taking on more interest rate duration risk by investing in longer dated fixed rate bonds, which compensate you for losses on, fixing your interest rate risk. Or you could take on more credit risk, which is, otherwise known as default risk as well. So by investing in high yield bonds, sub-investment grade, unrated securities as well. Or you could drive returns by taking on more illiquidity risk. So investing in illiquid loans and other illiquid securities as well. So that's fairly easy to deliver. It's not rocket science to realize that if you're going to take on more risk, then you should get compensated with a higher rate of return. What is harder to deliver is generating capital gains or alpha via finding mispriced bonds and trading. And that's what Coolabah is in the business of doing. This is why we have, such a large team. This is why we're typically trading 70 times a day. This is why we have such an intense process, because what we're trying to do is we're simply trying to find mispriced bonds that are paying too much interest after you adjust for their risk factors. So we are looking for bonds that are paying too much interest. So after you adjust for example, their industry, their issue size, where does it sit in the capital structure? What is the liquidity of that bond? And if the traded interest rate of that particular bond is higher than its fair value, then we will look to buy that bond. And as that interest rate then drops towards fair value, we sell it for a capital gain. And what we're focused on doing is then capturing those capital gains, much like your active equities manager, but in fixed income. This is why we're rarely, in fact, we don't buy and hold to maturity. We're actively trading, as I mentioned. We only invest in securities that are issued by entities that are unquestionably strong, that don't have any, intrinsic default risk either. So we focus on oligopolies and monopolies and entities that have either an implicit or explicit government guarantee. So we don't invest in Brisbane Airport. We don't have any airlines in our portfolio. We also don't have any real estate investment trusts. What you would find in our portfolio are the Aussie major banks and the state governments as well. Where we have invested in corporates, these have included, the likes of Woolworths, Coles, and Optus Singtel, which frankly is 100% owned by Singtel, and which is then 50% owned by the Singaporean government. So again, very, very strong credits. In terms of understanding, our alpha or our ability to capture capital gains, this is another screenshot from our system. And what we've done is we've captured all of our trade realizations. So all of our bond sales since 2012, so since inception to today. And all of the black dots reflect actual total returns that we generated from each particular bond trade. So in this particular dot, or this particular bond that we're hovering over in this screenshot, you can see that it's a NAB 22 bond, it's a subordinated bond, and we made 21.8%. These are money weighted returns, and they're not time weighted. So they reflect the IRRs, or the internal rate of return, that we've generated on these particular trades. And also these total returns are not annualized either. If we were to summarize all of these individual black dots, or all of these individual sales, we are talking about 16,239 realizations with a face value of 16 billion. Now, to the right-hand side, you can see some of our win ratios. Now, the total return win rate is 98.2%. This is very simple. It measures the percentage of times that we buy a bond and we make money. However, that obviously includes the coupon, which is, to be honest, the passive component of owning a bond. If we strip out the coupon and focus purely on the capital gains, our capital gain win rate is 88.1% across 16,239 realizations. And our average credit rating on each of the securities that we're investing in is also A+, so extremely highly rated. The median holding period is also 65 days. So we're definitely not buying and holding to maturity, as I suggested earlier. If we look at the actual returns of each of these bond trades and strip out what is the coupon and what is the capital gain, we find that the coupon return is only 2.6% over the last 8 to 9 years. And frankly speaking, that's a fairly boring rate of interest, or a miserly rate of interest. However, that is consistent with what you would expect from an average A+ rated floating rate note over the last 9 years. And so I should say that, we hedge everything back to a zero interest rate duration or floating rate, because we don't want to take on any additional interest rate duration risk. So our strategy is typically zero interest rate duration. But what we're doing is we're taking, what is on average an A+ rated bond that only pays a 2.6% coupon, and then we're augmenting it with a capital gain return of 8.5%. I've mentioned that we've been particularly active over the course of this year. So you can see that in January, we were net selling and de-risking the portfolio. And over February and March, we were actually net buying. Since from April to July, we were net selling. And then since August, we've been net buying again. And that's been us moving into the state government bond market and picking up state government bonds in anticipation of RBA QE, which we received, and has been a massive driver of alpha for our portfolios as well. So on the left-hand side in that table, you can see the volumes that we've sold and the volumes that we've bought. So, collectively, we're talking more than 19 billion as well since the start of this year. And you can see that, if I broaden this range to 2019, we've been particularly active pre-COVID. As I mentioned, we were de-risking, so we actually sold $1.14 billion of bonds in Jan. And again, we were particularly active over the course of Feb, March, and throughout the course of this year. And so what does all of this mean? Well, it means that, for Coolabah, as an extremely active credit manager, we are still able to generate very high returns with our active credit alpha. And in doing so, that's landed us amongst, the top sort of ranking amongst, key sort of ratings agencies, whether it be in Mercer or FE Fund Info, and also eVestment as well.